Good afternoon, and welcome to another edition of Philanthropy Friday. It's great to have you here today. My name is Mark Halpern, the CEO of WealthInsurance.com. And this is already our third year bringing to you great content of people who are making the news, who are the news, strategies, concepts, ways for all of us to be raising the tides so all the boats will rise as well around philanthropy and being able to give, and also tax reduction or tax mitigation. We love having people join us who are primarily made up of financial professionals. We have people involved with charities and fundraising. We have philanthropists. And then we just have voyeurs coming to get an idea or find some wisdom that can help them and their families going forward. I've been in professional practice for 35 years, and we work with some of Canada's most successful business owners, affluent families, corporate professionals, and you would think they'd have everything all organized and together. We find that 80% of the time it's not true. They're so busy looking after everything and everyone else. When it comes to themselves, they don't have things necessarily all organized. We help in three areas. One is in estate planning, making sure people's financial architecture actually coincides with their financial furniture. Secondly is tax mitigation strategies. We specialize in tax-exempt life insurance for high net worth families. And then the third area that we're involved with is philanthropy, which is really helping people create enduring charitable legacies, often just by converting tax into charity. And I sort of guess 90% of advisors are really not involved with this. So you might not hear this from your accountant or your lawyer, and probably 90% of the charities as well, are more focused on cash checks and credit cards and maybe appreciated securities. So you're not going to get a lot of high-level strategic philanthropic options as well. So if you're not hearing from them, chances are you're not hearing it all. And that's why we have created Philanthropy Friday, to be able to introduce you to things that are important. Today, I'm really excited because this is one of those like flow-through shares. Everyone's heard of flow-through shares. Some people have no idea what it means. Maybe it's a plumbing term, who knows? But we're going to unlock the impact of flow-through shares today with two amazing guests that I'll introduce you in just a moment, Peter Nicholson and Ken Stern, who are really thought leaders in this area. They're really the manufacturer. Peter Nicholson is a manufacturer of flow-throughs for many years, which we'll hear all about. Ken Stern is a dear friend I've known for over 25 years, who's a philanthropic advisor who's really making a difference in this area as well. So let's just go through a couple of things. Our mission at Wealth Insurance is really, we want to inspire and educate professional advisors across the country to be incorporating strategic philanthropy into clients' estate planning to certainly preserve wealth and create legacies. The other thing that we're trying to do is people they know what life insurance is, but very few people really understand what life insurance does. Life insurance can be an incredibly impactful tool for multiplying gifts in a very cost and tax effective way, as you'll hear today about flow-throughs. And then finally, we have a very aspirational goal to create a national community of 100 professional advisors and charities. If we're each creating $10 million a year, and we have 100 people doing that, that's $1 billion a year. And that's not like pie in the sky. It's kind of like crowdfunding. That's really what gets me up every morning. We have over 24 participants already. And if you're ready to become an expert in strategic philanthropy, we'd love to show you how to. And then what's the issue? We all know there's something called death and taxes in Canada. Well, this is true. Let's talk about the taxes on either a disposition of selling some assets or disposing of assets, or on the death of a second to die of a husband and wife. So registered assets being 54% tax. If you get $1 million RSP, it's only worth $470,000. Capital gains, any appreciation in shares or real estate or your business, whatever the gain's been, government wants 27% of that. Corporate holdings, you have money sitting inside an investco, a holdco, that can be taxed anywhere between 47 to 70% without proper planning. So it's really important to look at that. And then, of course, we have probate taxes of 1.5% on the market value of any asset, regardless of whether it's in single life ownership or a joint last to die ownership. The point is that there will be a tax there. When planning, you can avert some of this. So that's why it's really important to look at this stuff clearly while the sun is shining, to preserve more family money. We all have three possible beneficiaries to our estate. We've talked about this many times. You have family, you have the CRA, and you've got charity. And each of us can only pick two. Which two would you pick? Most people would take family and charity. And with proper planning, you can be remembered for giving a lot of money to charity as opposed to writing a big check to Ottawa and being forgotten. And the government's made it easy for us. They've introduced over 25 pieces of legislation since 1995 to make it more favorable to give to charities. And the government needs taxes. There's no question. We need to pay taxes, but there's no law that says you have to leave a tip. And the gentlemen today are going to help us to keep more of our taxes and to also include charity or to do both, which is fantastic. Last couple of things. We know that charitable donations in any given year can be used to mitigate up to 75% of your net taxable income, and any amounts over that can be carried forward for up to 5 years. In the year of death, though, I would say that 95% of the population do not know that charitable donations can be used to mitigate 100% of estate taxes, including going back the prior year. That means for every $2 you leave in your will or through some creative structure to charity, you turn $1 of tax into $1 charity. How great would that be? Life insurance can also be paid and owned by a charity, by a private foundation or donor advised fund. Note that there's no AMT, alternative minimum tax on death. We're going to be hearing from the experts today about alternative minimum tax as it applies to flow throughs. So if you are giving money, stop giving checks, credit cards, and cash is the most cost and tax inefficient way to go. And we're just going to leave with this one slide because this is where our experts come in today. This is an example if somebody wants to give $1 million to charity, they either give cash or low cost appreciated public securities or flow through shares or life insurance. As you can see, giving cash costs you 50 cents on the dollar. Giving appreciated securities costs around 23% approximately. Flow through shares, depending on the jurisdiction that you live in and what's available, can actually cost anywhere from 1 cent to 15 cents. Did you hear that? 1 cent. It's not a typo. I didn't speak out of term. So imagine how much more impact you can give. And then, of course, you can see here on the life insurance side as well. So without further ado, I'm going to introduce to you our amazing guest for today. Here we go. We've got Peter Nicholson, who is the founder of the foundation WCPD, who's a national expert in tax-assisted giving, who's helped move millions and millions of dollars to charities using flow-through strategies. So he's the manufacturer. Ken Stern is a philanthropic advisor with Capital Ideas here in Toronto, who has actually been a distributor, who's actually put these concepts in front of his clients and in front of charities and donors to help people give in the most cost and tax effective way. And I also just want to say about Ken Stern, we go long back. His late brother and I, Michael Stern, were very, very good friends. But Ken and I, we both qualified for the $1 Million Round Table for the first time in 1995. And I went in as a civilian qualifying. And Ken went in as a first-time member of MDRT and a first-time member of the Top of the Table. So everybody walked around him with their jaws open like, first time and you're top of the table? Anyway, gentlemen, welcome to Philanthropy Friday.
Hi, Mark. Thanks for the warm introduction.
Great.
Yeah, nice
Peter,
to see
it's
you,
good.
Mark.
Thank you so much. Peter, why don't we start with you? Tell us a little bit about yourself, your background. Tell us about, WCPD. People want to know, like, who are you and what's this all about?
Sure. Okay. Well, I'm a father of six. We'll start there. So,
That's good.
children between 27 years old and 9. So we're a very busy family. Started in the financial business in Atlantic Canada. I grew up in Nova Scotia. 1987, I finished a BCom at Dal, and I started with London Life. I was with them for 2 years, like a lot of great salespeople, great sales training, and then I've been on my own ever since. We still have an insurance boutique, our firm. But we really got into tax in 1995 and onward. So we found that's a great door opener. Tax is complicated. There's many strategies that we can work with. And what we also found is, the accountants don't usually have access to flow through shares. They look at that as an investment. And then the financial advisors, the stockbrokers, well, it's an investment, but it also has a lot of tax involved. So Ken and I are kind of in that middle ground, that lane in the highway where accountants and tax lawyers don't go into, other than some advice, and the financial advisors generally, don't want to get that involved, other than sending referrals. So it's a great product. We'll talk about the flow through shares, but we started 95 reducing tax, and then in 2006, Stephen Harper really finished the job that Paul Martin started to increase philanthropy in Canada. No capital gains tax if you donated public shares. Paul Martin in 1997 had set a half capital gains tax. I wish I was smart enough in 97. I could have been started this business of the charity flow through shares, but I wasn't. I had to be hit over the head with zero capital gain when I knew, yeah, exactly. Wow, flow through shares are all capital gain. The adjusted cost base is ground down to zero. So obviously, it's like founder shares. And we've had a great run. We're about to have 20 years of doing this structure. I've done 8,000 personal and corporate tax returns. We've grown it so that we'll probably do about 300 million this year. It's a great time, and you can always learn more about philanthropy. That's why I'm also a student of Mark's with Platinum. Always can learn more, the intricacies, and sometimes you have to have refresher courses as well. You might have to listen to this tape twice because the first time doesn't always sink in completely. So that's
Beautiful.
a good start for me. And
A
Ken and I
great,
have been together, working together for about 3 years now. He's one of our all-star people with flow through shares, structured
fantastic.
flow through shares. Yeah.
Thank you. That's a great introduction. And yes, I think that just everyone should know that Peter's being very modest. He is really a builder of this industry of the flow through and the entire vertical here. So I can't wait to get into a little bit more subject matter there to help people understand that what they can do. Ken, tell us a little bit about your background, because you've had you were involved with some interesting investment work for a long time. Maybe you can just tell people where you
Yeah.
came from.
So after quite a number of different careers in my late 30s, I found the insurance business, which I got licensed for fairly quickly, and then realized that investments seemed to be a little easier to talk to people about. And so I ended up in a 30 plus year career as an investment and insurance advisor. A lot of my work was in the world of alternative investments. Um, I sold my business, my investment business, in 2017 and thought I was going to retire, but found a few things. Number one, had still lots of energy and brain power, and I needed something to do. So when I sold my business, I found out about this transaction, flow through shares. They were not something I got too involved with as an advisor. I had a disastrous experience with a typical flow through LP, which is very different than the way we do it. But I found this transaction, and shortly after becoming bored, very quickly, I found Peter and have been working with Peter and his organization, top notch people, very responsive, experts in tax. And so I talk to people across the country, whether they're investment advisors who bring clients to me, or I deal with accounting professionals, lawyers, et cetera, directly. So this is my avocation, my vocation. I've fallen in love with this business. I love what I do. And working with Peter and WCPD is great. And I'm now fully engaged in the philanthropy side of this transaction. So glad to be
Amazing.
chatting about it.
Amazing, Ken. You know what? It's funny how you described it. I would suggest that most people come to flow throughs and even things like donor advised funds. Like, where were these things all of their life? I always like to say that, until you have a baby, you don't realize there's a whole aisle at Shoppers Drug Mart that has baby stuff. And all of a sudden, you have a baby and suddenly, wow, where did this aisle come from? And it's the same thing with flow through and things like donor advised funds. Unless people know about it, they don't know. But once they find out about it, it's like, where have you been all my life? So, Peter, why don't we start with that? Flow throughs really are, they are something that people don't know about. Okay. The majority of people still do not know about. I don't know why
Right.
that is. Maybe you can let us know. But also, they have the ability to supercharge giving. If you're a generous person, they allow you to give at the least cost possible, which means you can give more or you can give the same amount at less cost, and
Yeah.
also tax saving. So why is it that people don't know about it? So maybe you could just talk to
Yeah.
us about that and go from there.
Okay. Sure. Well, look, we'll start at the beginning, the history of it. They've been tax policy for our government since the 1950s. A lot of people peg it at 3 years older than RRSPs. So that's significant. RSPs came in 1957. They're there to basically have the government, they understand how valuable the minerals, and prior to Justin Trudeau shutting down oil and gas about 4 years ago, oil and gas and mineral exploration. Those are the categories that fit. Uh, Maybe down the road, we'll have technology flow throughs. Mark Carney put that on page 48 of his plan. We'll see this fall in the budget. But right now, it's those two categories where oil and gas and mining. And really, for the last 4 years, it's just been mining and specifically extra tax deductions for critical minerals. Those are the minerals that are going to be able to find more lithium, cobalt, copper, uranium, so to make that electrification change that Canada's such a leader on. So the unfortunate thing is they're hard to find and full of failure. 1 in 100 drill programs become a junior mine. 1 in 1,000 becomes a real Voisey Bay. So that's a massive failure rate. And the government understands that. So they'll shoulder that risk, just like an RSP, they'll give you a 100% tax deduction. So if you wrote a check for, let's say, $50,000 and your income was 250, now it'll be 200,000. So they're big supercharged RSPs. There is alternate minimum taxes maximums where the RSP maximum is 32,000. If someone made 300,000, usually you can shelter about 30%, so 90 grand. So very significant portions. With the flow through shares, Canada has become the leader in mining. And I'll give you an example. Everybody in the world knows Canada is one of the best or the best at hockey. 45% of all NHL players.
Except if you live in Toronto. Just want to. Sorry. Go ahead.
Yes, you're all baseball fans now. Yeah,
Yes.
well, yes,
Sorry.
maybe next year's our Leafs, but you're right. So 45% of all Canadian hockey NHL players are born in Canada. That's down a bit because the Europeans have come up a lot in the last 20, 30 years. But 65% of all the world's mining companies are Canadian based. We
Wow.
do mining way better than we do hockey, and that's a big surprise to people. And a lot of it is because of this government policy that's been there for 70 years to help create mitigate that risk. So the government will shoulder that risk at with the 50% tax deductions. Then recently they've also added more credits. In 2001 they added a 15% federal credit, which is twice as good as a deduction. And then just 3 years ago, Christian Freeland added the 30% critical minerals. So 30% credits for critical minerals, that's helped electrification, and 15% for the precious metals. So don't ever think that I want the listeners to understand this is not a tax loophole. That a loophole is something that the government does not want you to use, that they weren't expecting someone to use it, that they're going to shut it down. This is government policy that they want more of. More drilling is more jobs. And when, even though the numbers aren't great for the investor as far as the risk is high, but the reward is substantial, massive, very similar or higher than venture capital. If a penny mining stock hits something, Mark, it's not unusual to have 10 to 1, 100 to 1, or even 1,000 to 1 growth on it. But the good news for the government is 100% of the time they get jobs. Even when the drill bit doesn't find anything, the jobs to create that drilling is up north, indigenous jobs, and that's why Canada will continue to use these. This is not going to go away anytime soon. As a matter of fact, if technology comes, that'll be another layer. So that's what my main point is, that the government wants you to do more of this. And the second policy is you could give the cash proceeds after you sell it to a liquidity provider to de-risk this to charities. And that'll give you a second deduction on the same group of dollars. Again, the government doesn't care if Ken gives the jobs with the flows and Peter gives a donation of cash, or Mark does both, because Mark's smarter than both Ken and Peter. He's going to get two tax deductions rather than one. And that's it. That's basically it in a nutshell. The government wants you to do more of this.
So it sounds to me like for some people they might say, "Wow, this sounds complicated." There's a whole bunch of different moving parts
Mm.
here. Obviously, there's no cookie cutter here, and that each person has a unique situation that has to be discussed with regards to themselves and their professionals, whether it's charity maximization they're looking for or tax or both. Is that correct?
Yeah, I think that is fair and correct. I mean, most of this world has turned into areas of specialization,
Yep.
right? That you're really good at what you do, and everything else you kind of delegate. Yeah, and so yes, the substance of it is these mining companies that issue flow through shares. They're small. That's not the Barricks and the Techs of the world. They don't have any revenue yet. They haven't found the mine. They're out looking, so they might have $5 million of expenses, Mark, on the drilling expense, and they're allowed to flow through. That's the name flow. That $5 million of business deductions that they can't match with revenue because they have none, to taxable corporations and individuals that reside in Canada. And so the 5 million goes on our personal returns or on your holding company or operating company. And yeah, we definitely always involve the accountant, because we want to get the numbers right. We want to get the alternate minimum tax right. And a lot of times, what your viewers will look at is what really is the benefit. I don't need to know all the mechanics of how this car that I'm sitting in, does it really work. I just want to know, how do I get to A to B, and we'll help you get to A to B and understand the real benefits, through this, through more dialogue on this call.
Beautiful. Ken, who would you say is the most, it's this program, the flow through, is best suited for? Like, obviously, if somebody's on a pension, they're collecting CPP and OAS. I mean, who's it best suited for? And maybe you can just walk us through, like, what happens. So now I'm interested in flow throughs. Walk me through, follow the bouncing ball to see how it happens from soup to nuts.
Right. Okay. So the most appropriate way to participate in this is when you're earning north of the top marginal tax rate. So we use 250K, for instance. That's when you get the best bang for your buck. The highest taxed asset. So whether it's in a holdco where you're getting taxed on passive income, or an opco where you're past the $500,000 threshold for small business deduction, or past the $50,000 threshold for passive income in an opco, this is where our strategy shines. One of the issues in terms of people not knowing that much about this is, first and foremost, it's only available to accredited investors. So people may have previously, non-accredited investors may have participated in a flow through a limited partnership. That's not the same, because there's a ton of risk that exists in those partnerships that we mitigate with our transaction. So we'll talk to someone and get a picture of their financial well-being, we'll call it. Look at their tax payable. Our back office, so Peter's back office, is expert in tax analysis, whether it's personal or corporate, and we will come up with an optimized amount that will provide the best result for what I call the participant, because this is not an investment per se. It's merely a transaction, and we mitigate the risk by having somebody in the background to buy the shares from our participant the same day at a prearranged price that the client already knows about. So I spend a lot of time talking to people, educating them, dispelling some of the myths and fears they might have. Like Peter mentioned, often people think it's too good to be true. So after educating them and their accountant, often, we will get a set of facts, a fact pattern per se, and we will analyze that and make a recommendation to optimize the benefit. So
Ken, is there, is there any
also,
cost? Is there any cost for somebody to sit down with you to do that analysis to get to the point where they see the benefit?
no, no, that's what I do. That's my pastime. So I'm happy to talk to people. I make myself available, even though I'm in Toronto in the Eastern time zone. I deal with people across the country, and I say, if you're working, I'm working. So if you have a 5 p.m. meeting in BC and it's 8 o'clock here, I'm available. So I do my best to just educate people, do the analysis, and then we have to wait for product. It's not always available. Although I will tell you now, because the mining sector has gotten traction more recently, shares are going up. There's more and more product available. And just, sort of in the background, mining companies are less willing to issue shares when the prices are low. If they need $1 million and it's $10 a share, that's how many shares they have to issue. But if it's $20, they have to issue fewer shares, meaning less dilution to existing investors. So there's a yin and a yang, ebb and flow to this.
And Ken, as far as you mentioned about somebody at the highest end of the marginal tax rate, what about somebody else? Like, is it just for the wealthy? Like, I mean, and by the way, if you live in Toronto and you're at the highest marginal rate at $220,000, you're not going to Florida. I'm just saying it's expensive here. So
yes, so it's for anyone who's an accredited investor. As your income goes down, the benefit goes down. So we might have an after-tax cash on cash rate of return of 22%. I know that sounds high, but that's what it is. So when you start going down below the top marginal rate, that return might be down to 16 or 17%. Mm-hmm. It's still a very good return. It's just not optimized.
Got it. And Peter, Peter, I'd say that there are probably a bunch of misconceptions about flow through. Again, people are afraid of getting out of their lane and something that's a little bit more complicated. Concerns about, let's say, reviews by the CRA on these. People have heard about people who have done some more, let's say, ambitious or creative things, and then it comes back to bite them. And maybe you can just talk about that if you don't mind.
Sure, absolutely. Well, look, the good news is not only do we have the 9 advanced tax rulings on this structure, so that's 8 more than I've usually ever read on other tax deals I've done since the mid 90s. What I love to talk about is also the pedigree, the 8,000 corporate and personal returns that just our firm has done. There's 3 other competing firms in Canada that do this. We're a niche of a niche, so there's a total of 4 of us, and none of us have any CRA issues on our filing. So I mean, CRA, there you get your T slips, your flow throughs come in a T slip, your charitable receipt. So CRA understands where these deductions are coming from, and it does not create a red flag. They're used to charitable deductions. They're used to flow through share deductions. There isn't any worry about valuation. Sometimes there's a worry on the donation of an artwork, for example, or a building. What's going to be the fair market value? We're donating cash that we just received 1 second after we own the shares. We sell them to a liquidity provider that is an institution that, like Royal Bank's Resource Mutual Fund or the Sprott Fund or AGF Fund, as long as we sell them at a discount, they'll take away the stock market risk. So there's no red flags. I can also say that we've only had about 200 paper audits on those 8,000. Never, and what a paper audit is, those are the ones that I've had 2 of them in my years of filing structured flow throughs of 20 years. They just resend in the slips. They also want to make sure that we're paying the capital gains tax. Since 2011 till now, we do have to pay a capital gains tax on the flow through shares. So as good as they were, as Ken said, a 22% rate of return if you don't give to charity, a 1 penny to 15 penny cost if you give it to charity. Those are always after our fees. And sometimes they want to make sure that the slips are there. CRA has those slips, they back check it, but that's not bad. 200 out of 8,000, and it is, yeah. And we actually were, just an anecdote story, when finance was going to increase the capital gains, I was there in finance in May, and Freeland and her team were saying, look, we want to help mining. We weren't aware that how much this was going to hurt flow through shares, capital gain. Maybe we should work on the AMT. So they know all about this. This is not something that the government and finance and CRA doesn't know.
It's got a lot of attention.
To do more of it.
Right.
Exactly. So it's not a scam. It's not one of those buy high, donate low stuff that we all heard in the 90s and the 2000s. This is a tried and true practice, and that's why we have a 20-year perfect track record.
Amazing.
Mark, I just want to add one thing about the transaction and the capital gain. So Peter said we have to pay a capital gain tax. And what trips people up often is, where's the capital gain? I sold my shares at a loss. You wrote them off. So now you have an asset that you paid 0 for. And so when you sell the shares, that's a capital gain. That's something
Yeah,
people have a hard time wrapping their head around, but that's where the capital gain
But again,
came
that all
from.
comes out on an illustration. It explains, it
Yes.
walks people through, and with
And
their
that
professional
includes,
advisors can see all the transparency there.
yeah, and the 21 or 24% after tax return takes that tax payable into account.
if there is a capital loss, great point, Ken.
Yeah.
If some people have capital losses that are listening to this on their personal or their corporates, this is a phenomenal. This is a guaranteed capital gain because the adjusted cost base of a flow is zero. And if you sell, we buy it at 100, we sell it to the liquidity provider for, let's say, 75,000. It is a $75,000 capital gain. But if they have 75,000 capital losses, you don't have to
Wash.
pay it.
Yeah, love it, love it. So
So
anybody who's
it's
listening who has capital losses,
doubles the
it's a
return that we're talking about, and
amazing.
yeah, and the returns are always that we're quoting are after fees, and you're right. What most people that go through this, Ken's seen it, they buy once the accountant, and we love to talk to the accountant. That also tells you it's a different type of tax reduction strategy. If it was a little shady, the last person we want to talk to are those very smart tax accountants and tax lawyers. We're the opposite. We want to talk to them and get them involved because they'll also help us where AMT is and all the other family members that are making over 225,000 or all the other different holding companies, etc.
So this is so interesting, and I'm learning so much myself because I'm investing some time and listening to you guys. I mean, I think we all have a little ADD, so it's kind of like we need to sort of sit down at times and have it explained to us. You mentioned about other providers, Peter, in Canada. Like I know you have there's WCPD, you've got Pear Tree, you've got Bear Tove, you've got Oberon.
Oberon,
Sprott is
yes,
that would be a player as
yes,
well. So again,
yes.
as a naive consumer, why would I shop around? Why would I come here versus here? Everybody, just curious.
Yeah,
What's the logic
sure.
there?
The structures are identical, so there's no difference. There's no extra tax risk to go with one or the other. The fees are virtually the same. And I think the key component is who's got the product. We generally have a bottleneck in that there isn't infinite amount of liquidity providers. Last year, as a group, we did 900 million. I know if we had a lot more, if we had double liquidity providers, we could have found another double that $1.8 billion dollars of people that wanted to write off the taxes, that wanted to help those two policies. So we need more liquidity providers. As the mining business is getting stronger because of the critical minerals, we do need more front end people. That's why we're actually talking to you about it because we can bring on new what we call front end. That would be individuals and corporations that have tax. So yes, it's a niche of a niche. Our firm gets along great with our four competing competitors, and sometimes we join forces. I join forces with my competitors because some of these deals are big. You got to come up with a 20 or 30 million dollar deal and have it close within 3 weeks. We did the largest in Canada, $100 million deal, and so sometimes you have to share it and syndicate it with your friendly competitors to be able to get these deals done.
Good. And one of the things that came up, and it seemed to be the flow through providers were certainly a lot more vocal, was when there was this whole change to the alternative minimum tax, the AMT,
Mm.
which I'd never heard about, to tell you the truth. My accountant, of course, suddenly we heard it for the first time, but it seemed to have an impact specifically in the area of flow throughs in terms of how much you could give. And then you mentioned about going to
Mm.
Christy Freelander, the former finance
Right.
minister, and them adjusting it for charity. Can you just talk very briefly about AMT and how it applies to flow throughs and how it's impacted you, but without getting too
Too
much in the
too
weeds?
deep in the weeds. Okay. Alternate minimum tax is there so that you can decrease your personal taxes to zero. No matter how much tax planning, the government wants there to be at least some tax there. And Trudeau had felt that there was just too much tax planning. The rich aren't doing their fair share. That was the impetus of changing the AMT. They also watered down how much people could give to charity. They watered down how much you could borrow to invest. These are all areas that the wealthy are doing, but the wealthy also create the jobs in this country. So just to kind of simplify it, Before the AMT change, if you made 300,000, you could shelter about 30% of your salary dollars, 15% of your dividend dollars, and 10% of your capital gains. So if you had a $300,000 capital gain, you got about 30,000 of flow. They moved it down to 20%, roughly speaking. So that $300,000 person she could only buy 60,000. But once Freeland understood that this was going to impact how much we could drill and how much critical minerals, they actually reversed it in August of 2024. They put out an internal email to saying we're going to move it back up to the regular rates of 30. Unfortunately, we all know that there was a prorogue in Parliament in 2024, so it never got through yet. But we do expect it will get through, and that's another plus that the government wants to help us buy more of these critical mineral flow through shares specifically.
Well,
Ken, do you want to add some more to that too?
Yeah, I want to add something about the AMT because until I got into this area, I was unfamiliar with it also. So it's a side-by-side calculation. You have your own tax return and then the AMT side by side. When it comes to deductions, flow-through deductions do not count. They are added back. Right, Peter?
Yeah.
Yeah, the flow through is added back, as is some charity added back, and there is just limitations on what you can deduct. So that's why the AMT always comes into play once you're starting to drive your income, your taxable income, down below a certain threshold. So it's in
It
in the
gets
tax software.
complicated and even to go one level, if you're at the first, you originally you only had AMT after 40,000, they would look at it. Now they moved it to 170,000. Again, remember they wanted to attack the very wealthy, the $1 million, $10 million income earners. But now we're getting really into the weeds. But we'll work with the AMT with your accountant, and you really should buy. How much flow should you buy? Well, you should buy as much as you can up to AMT. Because if you're not, then that's like you not maximizing your RSP. Now, if you're struggling financially, of course you can't maximize your RSP. But we're dealing with clients that are doing the max RSPs, the max TFSAs. They're incorporated, and this is the next level of tax planning that they need to do, and they need to maximize it. And because if they don't, they're paying more tax than they have to. And who would want to do that?
yeah, great. Look at, as we hear quoted, I won't say who quotes it, drill, baby, drill. We have a huge amount of natural resources that we got to get into the ground. Like, so it sounds to me, Peter, if you look at the horizon, I mean, we try to forecast, it seems like flow throughs are really here to stay. And if anything, there's probably going to be more advantages for consumers and from a tax point of view to be able to create the dollars to drill because the government's just not going to have the money.
Yeah,
Yeah,
Mark,
I agree with you. Go ahead, Ken.
I want to just reiterate the fact that there's no AMT at the corporate level. So you could get rid of your entire corporate income without worrying about AMT.
Beautiful.
It's
Okay.
just the individuals. But yes, I agree. The future looks bright. The government wants more of this. I think 20, 30 more years, if we want to go to by 2050, to wean ourselves off carbon. And then I guess the other most important part is because we sell the liquidity provider, there is no stock market risk. People have those horror stories that, Ken had bad performance. And we've got this, our business is doubles. If you don't do a structured flow where you sell to the liquidity provider, you're going to either hit a grand slam or 90%, unfortunately, it's a strikeout. And we just don't, our clients don't want that up and down, the massive rates of return of hundreds of percent versus, maybe negatives. We're getting everything as a double, and that's a nice feeling.
Good. So as we finish up, because we could keep going. I love this conversation. Charity. This is called Philanthropy Friday. We've talked in big pictures about, understanding flow through, understanding the tax, how it works, who it's for, etc. Let's talk about how big an impact this could be for not just generous donors, but for charities and what they're doing. Maybe we just talk about maybe some success stories or things we were able to do at what cost it came in at, just to give people an understanding of the potential, because that's really why I had you on the show today. Besides you guys being great professionals, this is something that the people have to know about.
Do you want me to start, Ken?
Yeah, sure.
Okay. So the way I try to explain the charity flow through is you're doing two policies. You write your check for 100,000. We sell it for, again, let's say $70,000. There's a $30,000 gap. That's because we don't have any stock market risk because the shares can't be sold for 4 months. So that liquidity provider is hoping they're not going to drop. And there's usually a premium, of course, on flows. So really the stock market value might be more 85,000 and they're getting them all at 70. Now you can donate that 70 though, and then get a $35,000 tax savings. Plus on the 100, we're just going to use easy math, 50,000 on the job creation of the flows. 50 plus 35 is $85,000 of tax savings on 100. It only costs you 15 grand in this example to give 70.
And then what happens?
So
Does the charity get the flow? Obviously, they don't want the flow; they want the cash. So that's
they
where
get
you
the
get this.
cash. Yes, they get the
So,
cash.
so
But
15 cents.
before, yeah,
So for
15 cents
15
on the dollar
cents,
right there
so I could
on
give
that
I could
example.
give $100,000 to charity at a cost
Yeah,
of $15,000.
Mark, I had
that's not unusual.
two good examples for you.
Please, Ken. Yeah.
So I helped someone do 100,000 or make $100,000 donation, and the net cost at the end of the day was $1,000. Now, the lower you drive the cost, the more the initial capital you need. So we can calculate if you want to donate at 5 cents per dollar, or 10, or 20, or 25. We can engineer an amount that you have to put up in order to drive the tax down that way. But I also want to make a point that this isn't for necessarily only large donations. I had someone who wanted to investigate this transaction, and I said, "Look, why don't you try it for yourself?" And he said, "Well, I'm not going to do much of a donation this year, maybe a couple of $1,000s." So I said, "How much is that going to cost?" He said, $1,000. I said, "What if that $1,000 could make a $10,000 donation?" Of course, he really liked that idea and went ahead with it. And so now he's become a client and is doing things on and on. So I don't want to give the impression that it's only good for very large donations. Anywhere in between. And we can work backwards from numbers. You say, I want to spend this much, or I want to donate this much, and we can calculate anything in between.
Beautiful. So it's all very
Yeah.
customizable. I think that's great.
Exactly. And just to show on Ken, I know with our firm, we don't have a minimum. I mean, we've had people want to do a $25,000 flow check to test it out. They could have done more, but this does look very good. And people are people; they want to test it out. Even though their accountant says a green light, their friend says I've been doing it for a decade, and we're fine with that. We're fine with testing it out. And then eventually, as they get more comfortable with the second year, the third year of filing, everything's working great, then they always go to AMT maximums, because why wouldn't you take the maximum of this of this great structure?
Well, think
Yeah.
about that. Think about what these gentlemen just said. If you give $100,000 of cash checks, credit cards, it's going to cost you 50. I mean, you're paying 50 cents on the
50.
dollar, right? We
Right.
talked about
Yep.
appreciated securities, so we're at 23 cents on the dollar. Here, you guys are really. That means if you're a person who's a generous person, and you are already giving money to charity, why not do
Yes.
it in the most cost and tax efficient way? And that's where flow throughs seem to be a no-brainer, to at least be looking at them as a strategy in your giving.
Mark,
Absolutely. And we believe. I just let me make this one point, Ken. I'll then pass it over to you. But the public shares, when you donate them, they're great. You don't have to pay capital gains tax. Then you can bolt on a buy sell flow through share to bring that cost at the lowest. It's 25 cents to give a dollar if you have a zero ACB or founder, or a 10 times 10 bagger. It's a 30-cent cost. We can still bring those down to that penny level. So don't just if you're giving appreciated securities. Fabulous. We always agree that that's the first step, but we can actually do better by adding. A lot of our clients, though, don't have a lot of public shares. They made their money in their private companies, and therefore they're forced to do flow through shares, as well as we can talk. Another chapter could be life insurance. Over to you, Ken.
Yeah, so actually, I want to make a combination point here. So, Mark, your philanthropy world delivers cash to charities when people die. We deliver cash to charities when people are alive. We are a perfect complement to each other. It's just a matter of time.
Besides the fact that I love you, Ken, and I love Peter, so that's also a great compliment. But not listen.
Yeah.
You know what? We also give money to charities while people are alive too, and there's ways to do that with insurance. Anyway, there's a lot of moving parts here. The bottom line is if you haven't been thinking about flow throughs, you don't know about it, and you are giving to charities, it's time to start talking to people like Ken and Peter about flow throughs and see how it can just be helping you to optimize your giving so that you can be even more generous. And I think that's really a very important point. And just last thing, guys, is there any particular time of year that this is better? Like I'm thinking for me and my clients, I'm always thinking the runway is kind of September to December 31st, because you got a tax bill that's coming up next April. This is the time to be donating appreciated securities to a donor advised fund, or donating an old life insurance policy, getting a big fair market value receipt on it, and using that for your 2025 taxes they'll do next year. Is there a time of year for this? Or are you guys getting calls in December saying, hey, when's the best time?
Peter, go ahead.
I'm going to give that one to you, Ken.
Oh, okay. No problem. No problem. So you can imagine demand increases significantly in the fourth quarter, which is a very difficult time. Now, the issuers know this, so they tend to charge a higher premium. Scarcity is almost always, although this year, we have some product, unlike prior years. But
do you have product right now? Do you have product right now?
Yes. There's no guarantee that we won't be short product. We have closed deals on December 31st. It's not ideal. None of us want to be working that hard on December 31st, but we do what we have to do to help our clients. But ideally, I think the best pricing is going to be earlier in the year. And one of the points I make with people is that you don't have to wait to get your tax refund. If you're making installments and you made $500K last year, now you're going to do $100K of flow. Your installments should have been based on $400 and not $500. So you can unilaterally modify your installments, and the government doesn't care as long as they get enough money by the time your tax is payable and due. So earlier in the year is better. Pricing is better, more deals. Summer doldrums, I would call it right now. People tend to be sleepy, but fall does tend to get busier.
Yeah.
Peter, you want to add anything?
Yeah, and sure, right on the point. And you can purchase flows several times throughout the year, right? As you build, and towards the fall, you've got a good handle on what your income is, whether you sold a building. That's when it really triggers, when you've got a big tax bill. But yeah, we've got about 50 million of product in the month of September. We've got some live product right now, if anyone's interested. And I'd like to think we've got at least another 50 to 100 million left to go before the end of the year. We have had a year, though, 3 years ago, where we had 65 million on our waiting list, but 100 clients didn't get filled. And that's because they waited too long. And this is huge. It's a 1 penny deal versus going back to 50 pennies is awful, right?
Yeah.
So
that's why I've always said, Peter,
yeah.
it's always the best time to deal with this stuff is while the sun is shining, right? Which is now, if you've got the capacity to sit down and talk about it. Now, we'll give your contact information. Obviously, it's available on the post, but people can just reach out to you by email or go to the website, I'm assuming, and just make some time to help coordinate and plan and do some analysis recommendations.
Yeah. Right. Well, and thank you, Mark, for this opportunity. This has been very nice.
This has been great. I learned so much. And Peter, also thank you for your confidence. Peter is a member of our powerofplatinum.com mentoring coaching program to take professional advisors who to become experts in the high net worth life insurance and strategic philanthropy. And Peter's been around for a long time. So the fact that he joined, you just see, you're either somebody who just is a wisdom seeker all the time. And Peter, I give you a lot of credit for that. So thank you for joining us.
Yeah, never stop learning. Never stop learning.
Exactly.
Okay.
Yeah. Guys, thank you so much for joining us today. And we look forward to maybe having you on another time to discuss any changes that might be happening out in the economy.
Thanks, Mark.
Thank you, guys. Appreciate it very much. Wow, that was fantastic. I really just enjoyed those guys. First of all, they're a wealth of information, and it's not so scary. It's not such a scary thing when you hear from them and take away all those risks and concerns and giving people sleepless nights. It's not going to suddenly, trigger an audit from Revenue Canada. They're going to want to get some information perhaps. But I definitely think it's something you should reach out to Ken, reach out to Peter, and see what we can do. Our next steps, I have the 48-hour rule. If something resonated with you on this program today, do something about it within 48 hours. Otherwise, it's forgotten. We're on to our next thing, and it gets buried someplace. And you miss out on an opportunity, or you miss out on the potential of having flow-throughs available when they are versus when they're not. Follow Ken and follow Peter on LinkedIn. They're active on LinkedIn with posts and interesting comments, so you can check them out. If you'd like, reach out to us. We have a 160-page tax letter digest. Each is 160 different strategies, including flow-throughs, on how to be more efficient with your giving and how to save taxes. If you haven't had a chance, watch my TED Talk at the Idea City with Moses Neimer. It's called The New Philanthropy. It'll help frame a lot of what we talk about. And if you're a professional advisor, invest in yourself. Consider getting the MFAP, Master Financial Advisor in Philanthropy. It's a professional designation offered by Knowledge Bureau, Spire Philanthropy, and the CAGP. Really will help you be much more professional in this area. And if you really want to ramp up your professionalism, consider joining our next cohort of Power of Platinum. We're starting in October. We've had over 200 advisors through the program over the last 5 years, where people have 2 times, 3 times, 4 times their revenue just by understanding the language and the use of philanthropy as the thin edge of the wedge to be in front of prospects and charitable people and professionals to help them with estate planning and tax planning. It will be a big differentiator for you. Lastly, learn about these things and incorporate them in yourself and collaborate. We work with advisors from across the country, certainly our Power of Platinum members, but we work with professionals across the country. There's a lot of opportunity here for everybody to share on, and we'd love to be on your bench to help you look good with your clients. One thing we suggest is don't ignore it. There's just far too much lying on the line by not doing this. Here's our contact information. Be in touch. Want to wish everybody a fantastic weekend, fantastic end to the summer. We've got some holidays coming up we're very excited about, and a great weekend and a great Friday. For those who are celebrating, I also want to wish you all a Shabbat Shalom. Have a good one. We'll see you again next time.